Tax season is just around the corner, and while typically this isn't a time of the year that many people are too ecstatic about, it is, however, a time of the year where you can keep tabs on your finances and calculate what you owe to the government, or if you utilize some of the tactics that we're about to speak of in this video, it might be a time of the year where you can up your tax return and then deploy that capital into something productive, because essentially a tax return is money you're receiving at the end of the year and kind of just appears out of thin air. Hey, what's going on, investors and savers? My name's Griffin, and in today's video, we're going to be speaking about something a little bit different than our typical investing videos, which obviously I absolutely love making for you guys in the audience, because those videos are always super well received, and I love helping you guys build portfolios to grow your wealth. But recently, if you've been following my community page, I made a quick poll basically just requesting what you guys would like to see more of on this channel, and the result was absolutely fantastic. About 300 of you guys voted for what type of content you'd like to see more of on the channel. The results, kind of unsurprisingly, were 41% stock market related topics, but then 33% of you did mention that you'd like to see some more tax related content. So in today's video, we're going to be doing a mixture of both, where starting off, we're going to be looking at some personal tax deductions that you can utilize in order to hopefully up your tax return. And then following that, once we do have a sort of a larger tax return, hopefully, what are some productive ways that you can utilize that capital and deploy it back into the market or into other sources in order to have a positive financial impact. Now, before we move any further in today's video, I want to take a couple seconds to acknowledge the fact that this channel just hit 25,000 subscribers in the audience, and I wanted to thank every single one of you who watch my videos and who have supported the channel over the years. I'm truly so thankful, and I can't believe, honestly, that we hit 25,000 subscribers. I honestly didn't believe that it would be possible, but thank you again for watching the videos, and I hope that you're benefiting from the content that I put out. So in order to thank you guys, I'm going to be giving away 3 copies of The Intelligent Investor that I'm going to be just shipping directly to the winner's doors. So all you have to do if you want a chance to win one of these 3 copies is subscribe to the channel, like this video, and then comment down below one thing that you're doing in 2020 in order to grow as a person. It can be on the personal level, on an educational level, or on a financial level. One thing that you're doing in 2020 in order to grow as a person, and I'm going to be announcing the winners in the next video. All right, so I think it's pretty safe to say that on a somewhat universal level, not too many individuals are all that ecstatic about paying taxes at the end of the year, because on a personal level, especially in Canada, where we have some of the highest taxes in the world, personal income tax is going to represent one of the largest deductions on the gross income of most people. So with that said, paying taxes is simply a fact of life that we have to deal with, but why not try to take advantage of personal tax deductions in order to lower our taxable income and thus keep more money in our pocket rather than the government's. All right, so personal tax deductions, what exactly are these? Well, simply put, a tax deduction is typically going to be an expense that you incur throughout the year, which can be deducted at the end of the year from your overall taxable income, thus hopefully, if done strategically, bringing you down a tax bracket, a marginal tax bracket that is, and then resulting in less taxes owed by you to the federal and provincial governments. If you own a business or run a company, then you probably already know all about tax deductions, because generally here, things utilized or purchased throughout the year in order to either generate income or run your business can be considered a tax deduction. For example, rent, hydro, gas for your car, leasing expenses, and a variety of other things. However, on the personal level, so for example, if you only have a job as your only source of income, then typically you cannot take advantage of business tax deductions. However, there are still some personal tax deductions that you should take advantage of if you can, which we're about to speak about in this video. The first and most widely recognized tax deduction on the personal level is the RRSP contribution, and that is because the federal government of Canada allows individuals to make contributions to their registered retirement savings plan on a pre-tax basis. The concept is actually quite straightforward. So let's say in 2019 you made $5,000 worth of contributions to your RRSP. Well, in this case, you would be able to reduce your overall taxable income for 2019 by $5,000. Now, before you go ahead and open an RRSP and deposit like 30 grand into it, there are some contribution limits that you have to respect. So if you're wondering how you can go about calculating these contribution limits, you can check the video that I'm overlaying right here, or you can log into My CRA and you're gonna have your RRSP contribution limits showcased on the main page. Also, an important thing to mention with the RRSP is that your contributions can be carried forward for all the way up to 5 years, meaning that if, for example, you make a contribution of $10,000 to the account this year, however, you know that in a couple years you're going to be making significantly more money, it could make fiscal sense to defer utilizing your contribution this year and waiting out for a couple years in order to lower your marginal tax rate in the coming years. Moving on now to the second personal tax deduction on today's list. This is one that is sure to catch the eye of all the students who watch my videos, because you can actually go about deducting from your personal income tax the interest that you pay on your student loans, which is easily a tax deduction that could be forgotten. With that said, in order for your student loan interest to be tax deductible, it needs to be received under one of the following acts, meaning that student loan interest on, for example, a student line of credit from your bank will not be tax deductible, unfortunately. Also important to note with student loan interest is that just like the RRSP, these deductions can be carried forward for up to 5 years. So if currently you're a student who doesn't make all that much income, well, you can defer these deductions for up to 5 years for once you graduate, for example, and you're making more income. Next up on the list for personal tax deductions is charitable donations, which I know for some is not going to be a huge shocker here. However, do remember come tax time that charitable donations can be tax deductible up to a certain percentage. So if you're in the giving mood this year, a portion of your donations can be tax deductible. In the same vein as the two last deductions that we looked at, charitable donations can be carried forward for once again up to 5 years. And in order for your donation to be eligible, it needs to be a donation made to a registered Canadian charity. Do note that every province and territory will have a different charitable tax credit. However, on the federal level, all donations under the value of $200 will have a tax credit of 15% of that donation, and then everything above $200 will have a tax rebate of 29%, and then on top of that, your territorial or provincial tax credit will be applied to it. So that summarizes the main tax deductions that you can benefit from on a personal level, and there are a couple more. However, for the sake of the length of today's video, if you want to learn more about personal tax deductions, then make sure to check out the specific blog post that I made on this topic on my blog. And while you're at it, if you're looking to start your own business, then make sure to check out the small business tax deductions article that I made on my website. So hopefully at this point, after utilizing some of the tax deductions that we just looked at, your tax return is just that much bigger. And now that you have some extra cash on hand at the end of the year, what are some productive and useful ways that you can utilize this cash in order to deploy it in the market and have it work for you and further benefit your financial cause? Well, for starters, step number one, and I know this is going to be quite difficult for many individuals, including myself, because honestly, human nature kicks in, and with some extra cash on hand at the end of the year, it can be really tempting to want to go and buy a new pair of sneakers or finally go on a trip down south to a nice beach in Mexico, for example. But honestly, is this the best way that you could be utilizing this tax return? I don't think so. So step numero uno is going to be having some self-control and not just going out and spending that tax return the second it hits your bank account. And yes, I'll admit this might be easier said than done. However, this should be a mentality that you not only adopt in and around tax season, but should be a mentality that you adopt all year round by saving and investing every single month. And this actually brings me right into my second step, which is the natural course of action of eliminating all high interest debt that you currently possess on your record. We've already covered this topic quite a bit on this channel, so we're not going to dive deep into the topic. However, the fact of the matter is, if you're carrying any consumer debt that's above, say, 5 to 6% here, or anything above that, that isn't utilized in a productive manner in order to generate income, such as, for example, with a mortgage on a rental property or funds that you've borrowed in order to fund a business and grow your business, then utilizing your tax return to chip away at that high interest consumer debt is by far one of the most productive financial decisions that you'll make all year. I guarantee it. But what if you don't carry any high interest consumer debt and you're expecting a sizable tax return this year because you've utilized some of the tax deductions that we spoke about earlier? Well, the natural course of action at this point would be to stash away about 3 months of personal expenses into a high interest savings account. And once again, we've spoken about this quite a bit on my channel. So if you've been watching for a while now, you know all about this emergency fund concept. You should have at a minimum 3 months worth of expenses so that if there's an emergency, you're able to go and withdraw those funds in a quick and efficient manner. But make sure if you do this that you utilize a high interest savings account. So currently in Canada, there's 2 really good options. The first one being the 2.45% high interest savings account by EQ Bank. And the second really good option would be the Wealthsimple cash account, which currently has a 2.3% interest. Now at this point, if you're going through every single step here and you're just crushing it, you don't have any high interest debt, you already have a sizable emergency fund, well, the natural course of action at this point would be to start investing your funds. Yes, of course we're talking about investing, because after all, what would this video be if we didn't mention investing at least just one time in the video? But do remember that even though we speak about investing in the stock market mainly on this channel, there are multiple other ways that you can go about investing your funds, such as, for example, investing in real estate. You can utilize your tax return to start a down payment fund for your new home, or you could go about house hacking in a duplex or a triplex. These are just a couple ways that you can utilize your funds to invest with in real estate. Even if this seems out of reach or unfeasible, it honestly really isn't. In Canada, you can get an owner-occupied loan for only 5% down, and same thing in the United States with 3.5% down. So with a bit of self-control and consistency of contributions towards a saving or investing account, this is definitely not as far-fetched as you might believe. And another way that you could utilize your tax return in order to invest would be investing in a business that you're already operating or looking to start up. For example, this YouTube channel is a business that I own and operate, and over the past couple of months, I purchased this camera, which, even though a little bit pricey, is absolutely worth it in my opinion, because it's going to benefit you, the viewer, and have a better quality overall. So this is a way that you could utilize your tax return in order to reinvest into your business and grow your operations. And finally, the last point that I want to mention in today's video is that once you've started consistently contributing to your savings or investing account, or investing back into a business system, make sure that you continue that momentum, you maintain that momentum, because ultimately momentum in any aspect of your life is what translates this into your everyday habits, and ultimately this translates into success. If every single month you're contributing to either a savings or an investing account, this quickly becomes a habit in your everyday life, and before long you don't even think twice about it. And if you're thinking to yourself right now, I've tried investing and staying consistent, but I just can't stay consistent, then one thing that I would recommend is setting up an automatic contribution to your investment account or your savings account on a monthly basis, or even a bi-weekly basis. Is totally up to you. Or another thing that you could do is utilize an application such as, for example, Milo or Wealthsimple's Roundup, which every time you spend on your debit or credit card, it rounds up the spare change and invests it into a well-diversified ETF portfolio on your behalf. All right, everyone, so I really hope you enjoyed the content of today's video, and come tax season, you will utilize some of the tactics that we just spoke about. And by the way, if you're interested in learning more about building your own diversified dividend portfolio, then make sure to check this video right here. And on that note, thanks again for 25,000 subscribers. I will see you in the next video.